Okay, let's maybe fast forward a little bit into the deal process. Let's say you've got a company where they're at the right stage and they're having conversations with the right firms to raise some capital. The next step, there eventually would be, maybe you get a term sheet, you see an offer from one or more firms. That's a moment where I think, again, a lot of founders, it might be their first time seeing that. They don't necessarily have experience there. What are some of the key terms that, how does the term sheet work? I guess to back it up, what are some of the key terms that are worth focusing on there? And maybe a little bit on the market today. What are some of the kinds of things that founders are likely to see in a term sheet?
Yeah, that's a great question, because markets are changing a little bit than they were a year or two ago. I would back up and say, so there's a group called the National Venture Capital Association. Their website's nvca.org, and they have like a model term sheet document and model financing docs. And most kind of down the fairway venture investors, right? Like they make their money on the company being successful and everyone having, a piece of a really, really big pie. They're generally not making their money on coming in and being heavy-handed and structuring things and things like that, right? And so like if you look at like our term sheet, for example, it's very close to the model NVCA term sheet on their website. And so I think 90+% of term sheets out there are within a half a standard deviation. Every venture firm might have their little tweak here or there, of that term sheet. And so like in my mind, like that's a good place to start. I think having an experienced attorney where all they do is tech, venture-backed tech companies, and they live and breathe this stuff, they can very quickly tell you what's in market, what's out of market, what should be negotiated, what shouldn't be negotiated. Because I think the most brain damaging thing for someone on my end of the table and for everybody is when you're trying to invest in a company, they're great, and like they have a friend of a friend that does like leverage buyouts or family law that they're trying to use. And it's like and what ends up happening is they negotiate the things that like are boilerplate that they shouldn't even pay attention to. And the stuff they should be paying attention to gets ignored. And it just makes it really painful and difficult. So don't try to kind of reinvent the wheel here. But I think in terms of like, specific terms, assuming you have a venture firm that is using the standard docs, the things you typically see and pay attention to are things like, valuation, the share price that they're investing at, right? And how much ownership the firm's going to end up getting, the board. And so board structure, how many board seats, who has the right to appoint which board seats, the type of security. So, there's, generally venture firms invest what's called a preferred security, which gives them ownership as if they had common on the upside, but gives them protection for their dollars, almost like kind of like debt-like protection on the downside, where if the company doesn't sell for much money, they kind of get their money back off the top. And there is something called plain preferred and participating preferred that, a lawyer can walk you through, and that's kind of important. I think where sometimes you'll see founders kind of stumble here is when they're looking for a really, really high valuation, so like the highest share price, but then the term sheet has other things that are out of market in it around, maybe the investor gets 2 or 3 times their money back before the rest of the investors get anything. And so I always advise companies that like a clean deal is the best deal. And so, just especially in the current market, again, that's not something we generally do, but just those are things that I would kind of pay attention to. And then the other thing is like, there will be things like exclusivity time. So how long you've agreed to exclusively negotiate with that firm to go close the deal. And really anything over 45 days in my mind is a red flag. Like, as a firm, just from an ethos standpoint, in my decade at S3, I think we funded every term sheet we've signed, and we do all of the work up front. And we think it's irresponsible and not the right thing to do by founders to lock them into exclusivity while they're generally still burning money and they're raising money because they don't have tons of it. And then do our work. And so we do almost all of our work up front, and everything else is legal docs and confirmatory. And if you see a venture firm that has more than 45 days to close a deal, has 60, 90, 120, that should be a red flag. They're just trying to lock you down, and then they're going to do their work. And so that's something that, I would really pay attention to. So those are kind of a few things to look at.
Okay. Yeah, those are really good points.